Good morning, I'm Pete Seiler, and this is Markets in a Minute for the week of April 20th. Markets got some much welcome relief on Friday morning following a joint announcement from the United States and Iran that the Strait of Hormuz would be open to commercial traffic for the remainder of the ceasefire agreement. Equity, bond, and commodity prices all reacted as one would expect. Global equity markets rallied, yields fell across the yield curve, particularly at the short end, and crude fell toward $80 per barrel. We also saw renewed weakness in the United States dollar, which provided an additional tailwind to non-U.S. equity and bond markets. On the earnings front, Q1 season kicked off this week with the majority of major banks reporting. One area of key interest was their exposure to private credit markets and the level of risk that this implies. Just go through some of the numbers. JP Morgan reported $50 billion of exposure. Wells Fargo came in at $36 billion, and Bank of America disclosed around $20 billion in loans. While these sound like large numbers, the magnitude is likely not large enough to lead to a systemic banking crisis similar to 2008, even under the worst-case scenario. Most of the banks have ample loan loss reserves and earnings to absorb potential losses before seeing an impact to their Tier 1 capital. That said, there are still significant risks lurking out there, primarily within regional banks and insurers. Unlike the major money centers, regional banks tend to have lower reserves, less earnings power, and tend to lend to smaller companies. While a single failure wouldn't necessarily lead to a credit event, widespread issues could put greater pressure on market-wide lending and liquidity. And then there's the insurers, which tend to have a good deal of private investments within their general accounts. Now, there's little to no embedded leverage here, so the risk of a systemic impact is limited. However, severe losses could greatly impair an insurer's ability to pay dividends to its policyholders and meet death benefit claims, which, under a worst-case scenario, could necessitate some form of bailout situation. So just to sum it up, the private credit risks we've been discussing for the last year or so are still indeed present, but as of now seem to be contained and are likely more of a 2027 issue than a 2026 one. Looking ahead to this week, economic data will be light once again, with retail sales being the highlight. However, we will continue to see a number of key earnings reports as the Q1 season really gets into full swing. The companies to watch next week will be Tesla and Procter Gamble, as well as a number of major defense companies and key regional banks. With that, I want to thank you for watching Markets in a Minute. Don't forget to like, share, and subscribe to get notifications of our future video content. Have a great week.